Welcome to Chain Reaction by Capital Copilot, your daily dose of the latest in cryptocurrency news, market insights, and blockchain trends. Let's get started. JPMorgan Chase just made institutional blockchain adoption real. The $4 trillion banking giant launched its first tokenized money market fund directly on Ethereum with an initial $100 million seed from its asset management division. The fund, called My On-Chain Net Yield Fund or MONY, holds short-term debt instruments paying daily interest. Investors can redeem shares using cash or Circle's USDC stablecoin, with a $1 million minimum. JPMorgan joins BlackRock, Franklin Templeton, and Fidelity in moving tokenized funds on-chain. Tokenized assets have grown from $3 billion to $9 billion in just 1 year, with projections reaching nearly $19 trillion by 2033. The regulatory environment is shifting fast. The CFTC released guidance on December 13th allowing Bitcoin, Ethereum, and USDC to be used as collateral in US derivatives trading for the first time. Hedge funds and miners can now use crypto holdings directly as margin instead of converting to dollars, reducing friction and bringing offshore-style trading functionality onshore with regulatory supervision. Meanwhile, the UK government plans to bring cryptocurrency under full Financial Conduct Authority oversight by October 2027. Bitcoin is currently trading at $89,641, struggling to hold the $90,000 level as markets brace for the Bank of Japan's interest rate decision on December 19th. Traders are pricing in a 25 basis point hike with 98% probability. Historical patterns show Bitcoin declined 23 to 31% following previous Bank of Japan rate increases, and analysts warn of potential drops towards $70,000 if the $86,000 support breaks. The Crypto Fear and Greed Index has dropped to 17, marking extreme fear territory. The altcoin market is facing a reckoning. Small-cap cryptocurrency indices hit 4-year lows in November, with the CoinDesk 80 index falling over 46% in the first quarter alone. While the S&P 500 gained 47% cumulatively in 2024 and 2025, broad altcoin baskets delivered negative returns. Institutional capital has migrated to names like Solana and XRP, leaving small-cap tokens behind. Altcoins now function as tactical trades rather than structural allocations. XRP is a standout exception. US-listed spot XRP exchange-traded funds have achieved 30 consecutive trading days of net inflows since their November 13th launch, accumulating approximately $975 million, with total assets reaching roughly $1.18 billion. This uninterrupted streak contrasts with Bitcoin and Ether ETFs, which experienced multiple redemption days during the same period. XRP is currently trading at $1.99. Ethereum is trading at $3,156, holding above the critical $3,000 support zone. Solana is at $132.25. Both are outperforming Bitcoin on a relative basis, but remain under pressure from weak risk appetite and year-end profit-taking. In infrastructure news, Solana's Firedancer validator client officially launched on mainnet in December after 3 years of development. This independent validator client eliminates single points of failure that cause 7 network outages over 5 years. Multi-client diversity is critical for institutional adoption, and Solana is now following Ethereum's playbook. That's a wrap for today's edition of Chain Reaction by Capital Copilot. We hope you're feeling more informed and ready to navigate the cryptoverse. Until next time, keep your digital wallets ready.